So let's look here at page number 225. This whole chapter is about financing, and this is an important chapter for a few reasons. First, what percentage of real estate transactions do you think have some element of finance to them? Of course, all of them. In the vast majority of real estate transactions that we do as brokers and agents and even as investors, the vast majority of real estate transactions are going to have some element of finance to them. So this is an important chapter to cover. We're going to talk about promissory notes and trust deeds and mortgages and sources of financing. So there's a lot of very important information in this chapter, and we'll start here, of course, on page 225. So at the top of the page, right underneath where it says purposes of financing real estate, I would write two things. The first thing I'd write, number one, I'd write the words forced savings. Real estate provides a forced savings program for its owner. I mean, here we are now in 2016, and think about the real estate market over the last 4 years. The real estate market has appreciated an insane amount over the last 4 years. But even assume you had an average, let's say, $400,000 home, and let's say that property appreciated 6%. That's $24,000 in 1 year. How many people do you think in society have the ability to save up $24,000 over the course of a year? Not too many. To be able to save $2,000 a month, that's not easy for most people. But if you own a home, you're going to get richer almost whether you like it or not over the long term. Real estate provides a forced savings program for its owner. The second thing that you might want to write here on page number 225, underneath forced savings, I'd write the word leverage. Real estate routinely uses this concept of leverage where we use a small amount of money to control a much larger asset. I mean, think about a $500,000 property. You want to buy that home. How much money do you need? You might need, let's say, 20% or $100,000. You don't need the whole $500,000. So real estate allows us to use a small amount of money to control a much larger asset. That's, of course, the concept of leverage. So real estate provides two things that are relatively unique. Number one, of course, real estate provides a forced savings program for its owner, where over time, you're going to get richer almost whether you like it or not. The second thing that real estate has is this concept of leverage, where we're using a small amount of money to control a much larger asset. Now, if you look here on page number 226, this cost of credit, of course, is the interest that we pay. So if you think about this at the bottom of 226, where are interest rates today? Well, interest rates are at historically low levels, right? They're routinely in the 4% range. But if you look at the last, let's say, 30 years, what's the highest interest rate you've seen in your life? Well, if you look at 1980 and 1981, interest rates were routinely in the mid to high teens. So the interest rates are extremely low right now. It's funny, I was at a real estate office here recently doing a talk, and I sat down so as to not to be rude to the next speaker, and the speaker after me came up and said, interest rates have never been lower. Housing is so affordable. And I almost wanted to leave the room and go have a drink, frankly, because just because interest rates are low definitely doesn't mean that housing is affordable. Yes, interest rates are very low and money is relatively cheap, but that doesn't mean that housing is affordable. I mean, the appreciation we've seen over the last 3 or 4 years has really put a lot of real estate, unfortunately, out of the touch of most people. So the cost of credit, though, at the bottom of 226 is the interest that we pay. We know that. And interest rates, of course, have never been lower today at the bottom of page 226. Now, one thing I want to share with you really quickly on page 228, you'll see this concept of the Federal Reserve Bank system on page number 228. So the Federal Reserve, of course, is our nation's bank, and the Federal Reserve can enact monetary policy that would affect the overall economy. And there's three ways at the bottom of page 228 that the Fed could influence the overall economy. And you'll see these at the bottom of page 228. One, of course, is the reserve requirements at the bottom of 228. Right below that, we, of course, have the discount rate. And the third black square at the dead bottom of 228 is open market operations, or the buying and selling of government bonds. So if you look at the bottom of 228, we'll start, of course, with the reserve requirements. Now, what are reserve requirements? Reserve requirements are the amount of money that a bank has to keep on hand. Banks can't lend all the money that they have in their vault. They have to keep a certain amount in reserve. And that amount is dictated by the Federal Reserve. Now, if we raised reserve requirements, let's assume today reserve requirements, let's just make something up. Let's say they're at 10%. If we raise reserve requirements to, let's say, 20%, that means the bank has to keep more money in reserve, which means that there's less money to lend. When we raise the reserve requirements, the amount of money that we could lend decreases, which is going to slow the economy down. So again, one note you might want to make at the bottom of 228, if we raise reserve requirements, that means banks have to keep more money in reserve. This would have the effect of slowing the economy. If we lower the reserve requirements from, let's say, 20% to 10% or to 5%, now the banks have to keep less money in reserve and there's more money to lend. That would stimulate the economy. So one note again that you might want to write at the bottom of page 228, we lower reserve requirements. This stimulates the economy because now banks have more money to lend and there's more money to go around. If we raise the reserve requirements, banks have to keep more money in reserve, which would have the effect of slowing the overall economy. The second thing that we should look at here at the bottom of page 228, of course, are the discount rate. Now, the discount rate is the rate that a bank would have to pay the Federal Reserve for very short-term borrowing. Now, if we raise the discount rate, just like raising rates on anything, if it's more expensive to borrow, you're less likely to borrow, and that would have the effect of slowing the economy down. So one note that you might want to take at the bottom of 228, if we raise the discount rate, this would have the effect of slowing the economy because now money is more expensive to borrow, even for that short term. If we lower the discount rate, this would have the effect of stimulating the economy because now money's cheaper, it's going to be easier for a bank to borrow, and then they can pass those savings along to consumers. Now, the third way that the Federal Reserve could influence the overall economy, of course, at the bottom of 228, is the buying and selling of government bonds. Now, what's a bond? Well, a bond, of course, is a debt instrument, and you can invest, of course, in government bonds. Now, if you were to buy bonds, the only problem with that from a societal perspective is if you saved all your money and you invested all your money in bonds, you wouldn't get a haircut, you wouldn't go buy a car, you wouldn't go buy a house, you wouldn't buy a TV. So if you saved all your money, this would, of course, if everyone saved their money, this would have the effect of slowing the economy down because money isn't flowing through the system. So if you had a bunch of bonds and I was the government and I came to you and I bought your bond, now I'm going to take that bond from you and I'm going to give you cash. Now, with that cash, you're going to go spend it, you're going to go eat it, you're going to go drink it, you're going to go put money into the economy. So if the government buys bonds, this would have the effect of stimulating the economy. And the reason that would stimulate the economy is because we're taking bonds out of the system and we're putting cash into the system. Now, on the other hand, if I came to you as the government and I sold you a bond, now I'm going to take cash from you and I'm going to put a bond into the system. This would have the effect, of course, of slowing the economy down if the government sold you a bond. So again, if the government sells bonds, they're going to put bonds into the system and take cash out. This would slow the economy down. If the government came to you and bought a bond from you, they're going to take the bond from you, give you cash, and you're going to go spend it, which would stimulate the economy. So again, just as a review, at the bottom of 228, there are three ways that the Federal Reserve could influence the economy through monetary policy. One way, of course, at the bottom of 228 is raising or lowering the reserve requirements. The Fed will dictate to the bank how much cash they need to have on hand. If we raise those reserve requirements, this would slow the economy down because now the bank has to keep more money in their vault. If we lowered the reserve requirement, this would have the effect of stimulating the economy because now there's more cash to lend because they have to keep less in reserve. The second way, of course, at the bottom of 228 is with regard to the discount rate. That's the rate that the Fed would charge the bank for very short-term borrowing. If we lift the discount rate, this would, of course, slow the economy down because it'll have a pervasive effect on the economy. This would slow the economy down. If we lower, of course, the discount rate, this would stimulate the economy because now money's cheaper. The third way at the bottom of 228 is buying and selling government bonds. This is also called open market operations. If the government bought your bond from you, they're going to take the bond and give you cash. You're going to go spend it. That would stimulate the economy. If the government sold you a bond, they're going to take cash from you and give you a bond, which would then have the effect of slowing the economy down because we're taking cash out of the system and putting bonds into it. Now, another thing you might want to look at here at the middle of page 229, of course, is the FDIC. The FDIC is the Federal Deposit Insurance Corporation, and they insure savings deposits. One thing that, of course, has been an update from the last few years is now each account is insured up to $250,000 per depositor. And you'll see that, of course, here at the middle of page number 229. So you put your money in the bank and an FDIC-insured account, relatively safe, and which is why the rates of return, of course, on bank deposits are so low. Later on in Chapter 13, we'll talk about rates of return on real estate. Obviously, rates of return on real estate are going to have to be higher than rates of return on, let's say, a certificate of deposit or a savings account because there's so much more risk involved in owning real estate as opposed to keeping your money in a federally insured account at a member bank. Now, another thing that you might want to look at here, of course, on page number, bottom of 229 and all of page 230, before we get into what's called the SAFE Act and a couple of recessions that we've had over the last, let's say, 30 years, an important look back at our real estate industry. If you look at the bottom of 229, 230, and 231, we'll start at the bottom of 229. There's this law called FIREA. And FIREA, of course, passed in 1989, and you'll see reference to this at the bottom of page 229. Now, if you look back at a recession that we had in the late 80s and the early 90s in our real estate industry, a lot of people candidly blamed appraisers for the recession of that era. And in 1989, a law called FIREA passed, and you'll see reference to this, of course, at the bottom of 229. FIREA basically requires that appraisers obtain a license. And it's hard to believe that back then, anybody could do an appraisal. There was no regulatory oversight or licensing of appraisers back then. That seems ridiculous. But even now, in 2016, home inspection companies in California are also an unregulated business. Anybody, myself included, could, with an iPhone and a camera and a clipboard and a pencil, basically conduct home inspections in California. There was no licensing or regulatory oversight of home inspection companies today. Now, I'm hoping that'll change over time, but right now it's basically a free-for-all. It was like that in the 70s and 80s for appraisers. Appraisers didn't have to be licensed until FIREA passed at the bottom of page number 229. Now, if you fast forward from that recession to the recession we experienced in 2008, 9, 10, 11, and 12, who did everybody blame for that recession? Well, we blamed lenders, right? Now, I know you could blame the consumer for taking out a loan for a house that they might known that they wouldn't be able to afford. Maybe you'll blame the bank. Maybe you'll blame the loan officer. But in response to this recession at the bottom of page 231, in 2009, something called the SAFE Act came into effect. And if you look at the bottom of page 231, you'll see reference to the SAFE Act. The SAFE Act basically requires that loan officers obtain a special endorsement in order to originate loans. So now anytime a loan officer hands you their business card, it'll have an NMLS number. NMLS stands for National Mortgage License Systems, and loan originators need to be licensed now under the SAFE Act. So again, just a history of the last couple of recessions. Of course, we had a recession in the late 80s and early 90s. In response to that, we passed FIREA, requiring appraisers get licensed. At the bottom of 231, this last recession, we blame loan officers. And now loan officers need to be properly licensed with an NMLS number under the SAFE Act here at the bottom of page number 231. Now, regardless of where you get your real estate loan from, you'll see at the bottom of 233, there's always two documents anytime you have a loan to purchase real estate. One document at the bottom of 233 is called a promissory note. And right next to promissory note, I would make a little note or highlight or underline. The promissory note is the borrower's promise to pay at the bottom of 233 and evidence of the debt. So the promissory note, again, is the borrower's promise to pay and evidence of the debt. Now, frankly, every loan is going to have a promissory note. A credit card has a promissory note. A student loan has a promissory note. All loans, a car loan, is going to have a promissory note. It's the borrower's promise to pay and evidence of the debt. Now, real estate loans will also have at the bottom of 233 something called a security instrument. Now, a security instrument is going to identify some collateral that would be forfeited in the event that you don't pay. I'll give you an example. So you go get a home loan. You're going to sign a promissory note where you promise to pay back the money. You're also going to sign a security instrument that says in the event that you don't pay according to the terms of the note, the bank can take your house from you. The fact that the bank can take your house is not necessarily so related to the promissory note, it's related to the security instrument. So again, two documents when you have a real estate loan. You're going to have a promissory note where you promise to pay back the money and it's evidence of the debt. You'll also have a security instrument which pledges your home as collateral for that loan. Now, car loans have a security instrument too. If I don't pay on my car loan, what happens? Well, a black tow truck shows up at 2 in the morning and takes my car from me. If I don't pay on my, let's say you have a boat loan, the lender can repossess the boat. That's a function of having a security instrument, not necessarily the promissory note. So again, real estate loans, we got two documents. We have a promissory note where you promise to pay back the money, and we have a security instrument which would identify collateral that would be forfeited in the event that you don't pay. Now, let's spend a quick second here at the top of 235 about promissory notes. Now, there's a couple of key vocabulary terms we should know with regard to the promissory note. One of these is the term amortized loan on page number 235. So promissory notes, the most common type in our real estate world are amortized loans. This word amortize basically means that you're paying both principal and interest. So as time goes on in an amortized loan, the loan balance gets reduced, right? And that's common. You think that's obvious, right? Every month I make a payment, my balance is coming down a little bit. Well, that loan is called an amortized loan. It's going to call for payments of both principal and interest. And you might want to make a little note of that here on page 235. The amortized loan calls for payments of both principal and interest. Now, frankly, this word amortize comes from the Latin word amorte, which literally means to kill. So as time goes on in an amortized loan, as time goes on, what's happening to our loan balance? Well, it's dying a little bit. And eventually, at the end of 15 or 30 years, the loan's dead. So again, for the test, if the test were to ask you the type of promissory note which calls for payments of principal and interest, that's of course an amortized loan. If it's interest only, and you'll see this at the top of 235 in bold, if it's an interest only product, it's of course known as a straight note. Now, in a straight note, you're not going to have any amortization, of course, because all you're paying is interest. So again, in an amortized loan, you're paying principal and interest. In a straight note, you might want to make a little note here at the top of 235. This is an interest-only product. Now, you might ask yourself, why would anybody just want to pay interest? What's the benefit to that? The loan's not being paid down in any way. Well, the benefit, of course, to a straight note is that all you're paying is interest only, which means that the payment is lower. That makes sense. In an amortized loan, I'm paying two things. I'm paying principal and interest. In a straight note, I'm just paying one thing. I'm just paying the interest. So, of course, my payment's going to be a little less on a straight note because all I'm paying is interest only. Now, if the test were to ask you again, the type of promissory note which calls for payments of interest only is a straight note. Principal and interest, of course, is known as an amortized loan. Now, let's say you bought a house last year and you don't remember which one of these you had. You don't remember whether it was a straight note or an amortized note. What document would you look at? Of course, you'd look at the promissory note. The promissory note has all the terms of repayment in it, whether it's a straight note or an amortized note, whether it's a 15-year or 30-year, whether it's fixed or it's adjustable. These are all found, of course, in the promissory note. Now, another clause that you might find in some promissory notes, and you'll see this at the top of 235, is a balloon payment. Now, balloon payment is typically a very large payment. It's typically the entire balance owed. But the exam might get you on a technicality here. A balloon payment is defined, and you'll see this on 235, a balloon payment is defined as any payment that is twice the amount of the minimum payment due. So anytime in the course of your loan, let's say you have a 30-year loan, the note calls for a payment that is 2 times the amount of the minimum payment due. Technically, that would be called a balloon payment. Now, generally, you and I are going to think of a balloon payment as the entire amount owed, and that's probably the most common way that a balloon payment will show up in a promissory note. But technically, it's any payment that is twice the amount of the minimum payment due. So again, the promissory note is the borrower's promise to pay and evidence of the debt. The type of promissory note which calls for principal and interest is an amortized loan. The type of promissory note which calls for payments of interest only, of course, is a straight note. So here, of course, at the middle of page 235, you'll also see this term joint and several liability. This is probably something that you might know already, but maybe you haven't thought about. Let's say that you and I buy a home together, and both of us end up signing the promissory note. So we both signed a promise to pay, and there's evidence of some debt. If you disappear after a year or 2 years, can I just send in my half to the lender? Of course not. I'm responsible for the whole thing. So lenders in a promissory note have a very common clause called a joint and several liability clause. And you'll see this here at the middle of page 235. Right next to this for the exam, I would write the number 2 and then a plus sign. I'd write 2+ on note. Anytime a lender makes a loan to 2 or more people, the lender would always have this clause in there called a joint and several liability clause. Basically what this means is jointly, you and I are liable, but also severally. Now, I know that word several sounds like it means many, but several in this context actually comes from the word sever, which means to separate or pull apart. So if you and I together sign a promissory note, we're liable on that loan. But also if one of us leaves, the other is still liable for the entire thing. That's, of course, a joint and several liability clause. So if the question on the exam were to say, anytime a lender makes a loan to 2 or more people, what words would you always see on the note? You'd see the words joint and several, very commonly asked on the exam. Now, another thing I'd look at here at the bottom of 235 is this term negotiable instrument. So right next to negotiable instrument, I'd write a couple things for the exam. The first thing I'd write are the words can be traded. A negotiable instrument can be transferred from one person to another. Examples of negotiable instruments, you might want to write this at the bottom of 235, are like checks. Cash is a negotiable instrument. A promissory note would be a negotiable instrument. Frankly, often in the real estate business, one bank might sell their rights to collect on a loan to another bank. That's because that loan, that note, is a negotiable instrument. It can be transferred from one person to another. Cash, of course, I could give you $100 for your, let's say, shirt, or I give you $100 for your briefcase or your bag, and that would be, the cash is a negotiable instrument. It can be freely traded from one person to another. So now, how does that relate to real estate? Really, in real estate, the negotiable instrument that's most often traded, frankly, is a promissory note. Wells Fargo will sell their loan to Bank of America. Bank of America will sell their loan to One West Bank and then to JP Morgan Chase. The right to collect on those notes is transferable from one person to another because the note is a negotiable instrument. Now, let's move on from the promissory note. I really want to talk about a lot of stuff that's on the test here on 239 with regard to security instruments. So remember, anytime you have a real estate loan, there's always 2 documents that are issued, right? There's a promissory note where you promise to pay back the money, and then there's a security instrument, which basically pledges the asset as collateral for the loan. So if you don't pay according to the terms of the note, the bank can take your house from you. Now, the security instrument for right now can take one of 2 forms. It can take the form of either a mortgage, here at the bottom of 239, or it can take the form of something called a trust deed. So the security instrument for right now can either be a mortgage or a deed of trust. Now, of course, in conversation, we use the term mortgage a lot. I refinanced my mortgage, I got a second mortgage, I can't afford my mortgage. Everyone uses the term mortgage. If you don't remember anything else from this chapter, just remember this. In California, lenders don't make mortgage loans anymore. In fact, a lender hasn't made a mortgage loan in California in like 60 years. Now you might say to yourself, well, why the hell do we keep calling them mortgages if it's not really a mortgage? Well, we got a lot of words like that in English. I don't know, Xerox, Q-tip, Kleenex, Jell-O. They're all just terms that we use to describe something, even though it might not be the best way or most accurate way of describing it. So a mortgage is the same way. Mortgages aren't really mortgages in California. The security instrument we really use is something called a deed of trust. The word mortgage just kind of stuck over the years. Now, in the term at the bottom, by the way, in the book at the bottom of 239 in this gray box, you'll see where it says the security instrument is usually referred to as a mortgage, even though in reality it's a trust deed or deed of trust. So if the question on the exam were to say, the security instrument of choice in California is the what? Deed of trust, right? We don't use mortgages anymore. We just call them that, frankly, out of habit. Now, a mortgage at the bottom of 239 is a two-party instrument. There's two parties in a mortgage. There's the mortgagor and there's the mortgagee. Now, who's the owner of the property? Well, the word mortgagor is the clue. Anytime for the test, you see the word, any word that ends in OR, trustor, vendor, lessor, grantor, mortgagor, all these OR words mean owner or giver. So the mortgagor is the owner, that's you on your house. The mortgagee, of course, is the lender. So on your home, if you had a mortgage, you'd be the mortgagor. Bank of America, let's say, would be the mortgagee. Now, what's interesting about this, a lot of people hear that and they say, well, that's not true. If I owe money to the bank owns my home. Well, think about this on your car. I have a car loan, unfortunately. Hopefully that torture will end soon, but I have a car loan. If a cop pulled up behind my car and ran my license plate, would it show Wells Fargo Dealer Service as the owner? No, of course not. I'm the owner of my car, even though the bank has a lien on my car. Similarly, on your house, you're the owner. You're the mortgagor. The bank is a lien holder, right? They're the mortgagee. So don't miss this on the test. If the question on the exam were to say, the owner of the property is the mortgagor, the lender, of course, is the mortgagee, right? The lien holder is the mortgagee. Now, we know that we don't use mortgages anymore in California. But the natural question is, well, why? Why did we stop using mortgages as the security instrument in California? And the answer, of course, to that is here at the top of page number 240. Mortgages require something at the top of 240 called judicial foreclosure. Judicial foreclosure is foreclosure through the court system, right? That word judicial implies there's a judge or it has a court process. Now, of course, you and I both know this. How long is court? Court can take a long time. Do you think a bank wants to have to sue you and take you to court in order to foreclose on you? Of course not. No bank is going to want to sit in court for a long time trying to get their collateral back. So instead of using a mortgage, which at the top of 240 requires judicial foreclosure, instead of this, we use something called a deed of trust, which basically lets the bank not have to go to court in order to foreclose. So again, just as a review, you get a real estate loan. There's two documents: promissory note, security instrument. Promissory note is evidence of the debt, borrower's promised to pay. The security instrument pledges the property as collateral, and it'll be forfeited in the event that you don't pay. The security instrument could be a mortgage, but we don't use mortgages. How come? Top of 240, mortgages require judicial foreclosure, which means that the bank has to take you to court in order to foreclose. That's a huge problem number one. The other really big problem with a mortgage is that mortgages, if you look at page number 242, we're going to come back to 241 in a second, but if you look at the top of 242, mortgages require or allow the mortgagor something called a redemption period. Now, a redemption period here at the top of 242 means that assume you lose your house in a judicial foreclosure, God forbid. So you had a mortgage and ultimately didn't pay. The bank is basically going to foreclose on you. How are they foreclosing on you? Through the courts, right? Which is why we don't use mortgages, but let's assume we did. So a bank has to take you to court in order to foreclose. This now allows you something called a redemption period. What this means is, top of 242, even after you lose your house in foreclosure, you still have up to 1 year to save up money and buy that property back even after the foreclosure. Do you hear of that in California where somebody loses their home in foreclosure and everybody who loses their house in foreclosure still has up to a year to stay in that house and recycle aluminum cans or donate blood or whatever they need to do to raise money to buy that property back? Of course not. Mortgages, the two big problems again, one is at the top of 240, right? Mortgages require judicial foreclosure. The bank has to take you to court in order to foreclose. Huge problem for the lender. The second big problem on 242 is that mortgages have something called a redemption period, which allows the borrower up to a year to sit in that house even after foreclosure and try to raise the money to buy that property back. Those are the two reasons why mortgages are not really used so often in California. So, true or false? A mortgage is illegal. It's not illegal, it's just bad business. No bank wants to have to take you to court and also have you have a redemption period of up to a year. Now, another term that's pretty important in a mortgage is at the top of 241. There's this term deficiency judgment at the top of page 241. So a deficiency judgment, I'll give you an example of this. I've been doing this for a while now and have weathered a couple of recessions. And, the market feels pretty good right now as we sit here in 2016. The market feels pretty good, right? We've had a lot of appreciation, and you have a lot of real estate agents that are making a lot of money again. And, I come to a lot of these real estate offices with newer office managers that have maybe just been in real estate maybe a couple of years, and they've seen this great bull market we've had. And a lot of the staff meetings, you'll have these team leaders or managers or brokers that'll tell their sales staff, go out and buy a new Mercedes. Go out there and lease that brand new BMW or Tesla. Trust me, it'll make you work harder, and you need to project a certain image. I almost want to tell that person you should not be giving ridiculous advice like that, because through the recession, routinely, I would see real estate agents have, their new Lexuses or their new Mercedes repossessed, frankly, from the parking lots of offices because they've overextended themselves. Now, imagine this. Imagine you're a brand new agent. You're taking the class. You're about to be licensed here in a little bit. Let's say you say, you know what? My Honda Civic doesn't project the image that I want. And you go out there and lease a brand new Mercedes. Maybe something very nice. Maybe this new S-Class. Payment's $1,400 a month. You last for 3 or 4 months, and eventually Mercedes repossesses the car. Now, the car was $140,000. When Mercedes repossesses that from you in 6 or 7 months, they're going to auction the car off, right? At auction, they might get, the car was $140,000, 6, 7 months later, they get $100,000 for it, or maybe less. Let's say Mercedes auctioned that car for $100,000. Now, you owed $140,000. The Mercedes company only recovered $100,000. I promise you, I guarantee you, that $40,000 difference, Mercedes will sue you for that $40,000. That's called a deficiency judgment. It represents the difference between what you owed and what they recovered. Now think about real estate. Let's say that I owe $700,000 on my house and I foreclose. Judicial foreclosure, it goes to a court auction. I owed $700,000, they only recovered $500,000. That $200,000 difference, remember I owed $700,000, they auctioned it for $500,000. That $200,000 difference is called a deficiency. The bank in a mortgage could sue me for the difference between the $700,000 that I owed and the $500,000 they recovered. Now, for the remember, that's called a deficiency judgment. Now, there's a couple of exceptions to that. One main one for the test is here at the top of 241. So again, top of 241, you'll see the term deficiency judgment. What is a deficiency judgment? It's a judgment by a creditor, a bank, representing the difference between what was owed and what was recovered. That's called a deficiency. Now, in a mortgage, a mortgagee, the lender, through this court process, could sue you for a deficiency judgment. Now, there's a couple of exceptions, but I'll give you the one that's in the book for the exam. See at the top of page 241, this first black square, it says, the mortgage was a purchase money debt. In English, that means if you bought your home with a mortgage and then lost it through judicial foreclosure, the bank cannot sue you for a deficiency judgment. You cannot get a deficiency judgment when the original loan is the one that foreclosed. Now, if I refinanced my house in a mortgage, I don't have that same deficiency judgment protection because I refinanced, I switched the loan, right? But deficiency judgments are not permitted on purchase money loans. And that a purchase money loan is the same loan you had to buy the property. So again, top of 241, what is a deficiency judgment? Just like Mercedes, it's a difference between what you owed and what was recovered. In our real estate business, when is a deficiency judgment barred? You cannot get a deficiency judgment when you had a purchase money loan. Now, if you refinanced it on a mortgage, you'll lose that deficiency protection, but you have it on a purchase money loan. Now, we don't use mortgages anymore. We use trust deeds or deeds of trust, same thing. So again, in California, you have a promissory note and a security instrument when you go buy a house. The promissory note is the borrower's promise to pay and evidence of the debt. The security instrument, again, pledges some asset as collateral that would be forfeited if you don't pay. Now, on page 242, you'll see the term deed of trust. This is the security instrument of choice. Even if you go to Wells Fargo and say, hey, I want a mortgage, the technical instrument they'll use isn't a mortgage. It's called a deed of trust here on page 242. Now, one difference you'll see in a mortgage and a deed of trust, remember in a mortgage, how many parties did we have? We had two parties, right? We had the mortgagor and the mortgagee. Those are the two parties in a mortgage. In a deed of trust, we have three parties, and you'll see these three on 242 at the middle of the page. You'll see we have a trustor, we have a trustee, and a beneficiary. So remember, two parties in a mortgage, three parties in a deed of trust. Trustor, trustee, beneficiary. Let's start easy. Who's the owner? Yeah, the trustor, right? How do you know that? It ends in OR. Remember, all those words that end in OR, trustor, vendor, lessor, grantor, mortgagor, franchisor, all those OR words mean owner or giver. So again, the trustor is the owner, borrower, that's you. The beneficiary, middle of 242, the beneficiary is the lender. So now we're kind of even, right? We have the mortgagor, trustor, same, that's you, the owner, borrower. We have the mortgagee, the lender, and the beneficiary, the lender, right? So we're even. In a deed of trust, though, at the middle of 242, we have someone new. We have someone called a trustee at the middle of 242. The trustee is going to hold title to your home or to your property, to your building, if you use a deed of trust, while you owe the bank money. Now, this doesn't affect your life in any way. The trustee is almost irrelevant, right? You probably owe money on your home. If you owe money on your house, you're the trustor, Wells Fargo's the beneficiary, you probably don't even know who the trustee is. And the truth is, it doesn't matter. The trustee doesn't have any rights to your property in terms of possession or occupation or the right to sell it if you're not in default, right? It's just you and Wells Fargo. However, the trustee is going to hold the bare naked legal title to your property with the power of sale. What that means is, if you don't pay Wells Fargo, who's the first person Wells Fargo calls? They call the trustee, because what do they got? They got the title to your property. So Wells Fargo will call the trustee and say, hey, this person hasn't paid. The trustee has the title. They'll sell the property for Wells Fargo. That's why if you go to a foreclosure sale in California, it's called a trustee sale, because the trustee is selling the property on behalf of who? On behalf of the beneficiary, right? So the trustee holds the title, irrelevant unless one of two things happen. What's one? We talked about this. Foreclosure. You don't pay the bank calls the trustee will then sell the property for the bank. The only other time the trustee becomes relevant is when you pay off the loan. Just like if you pay off your car, you're going to want the title to your car back. Surely if you pay off your house, you're going to want the title to your house, right? The trustee is going to have to give you the title back. That's called a reconveyance deed, which I'll show you here in a moment. But just a big overview. In a deed of trust, we got three parties: trustor, trustee, beneficiary. Who's the owner? Trustor. How do you know that? The word ends in OR, right? Trustor is the owner. That's you. The beneficiary is the lender. Remember, they benefit from all those interest payments you make for 30 years. The trustee is going to hold title to your property while you owe the bank money. Who's the trustee? It could be a title insurance company, some company set up for that purpose, but they're basically going to hold title to your property while you owe the bank money. And they'll foreclose on you in the event that you don't pay the bank. Now, one thing that we might want to look at here on 242, check out this second to last paragraph at the bottom of 242. You'll see that it starts with on the trustor's default. Now, I wouldn't miss this one for the exam. Remember, on a mortgage, how do we foreclose? We're foreclosing judicially on a mortgage. Now, on a deed of trust, we don't want to foreclose judicially because it takes too long. That's why we got rid of mortgages to begin with. On a deed of trust, we're going to foreclose using a trustee's sale. But think about this. If you didn't pay the bank, couldn't the bank take you to court? Couldn't they sue you? Yeah, the bank could sue you, right? It's a contract. The bank gave you some money. You promised to pay them back. If you don't pay the bank, you're breaching that contract. Anytime someone breaches a contract, where could you take them? You could take them to court. So don't miss this on the test on 242. I would highlight that first sentence. It says, on the trustor's default, the beneficiary, that's the lender, has the option of requesting a trustee sale or a judicial foreclosure. You have the option in a deed of trust. You could foreclose judicially if you wanted to, but the lender wouldn't do that. It takes too darn long, right? Instead, we're going to use something called a trustee's sale, which is cheaper, faster, and more efficient than a judicial foreclosure. So here at the very bottom of page 242, we talked, of course, about the fact that a lender actually has a couple of options. If a lender wanted to foreclose on you judicially with a deed of trust, they could, or they could foreclose on you through a trustee sale, which in practice, they're going to be doing a trustee sale. Why? It's cheaper, faster, it's more efficient than judicial foreclosure. Now, if you look at the bottom of 242, do me a small favor. Let's just write a little flow chart here at the bottom left of 242. We'll talk for a moment about the non-judicial foreclosure process, also called a trustee's sale. So the first thing that you might want to write at the bottom of 242, I'd write the words notice of default at the bottom of 242, maybe somewhere on the left. A notice of default is the first step in the foreclosure process. Now, a lot of students ask, well, how many payments do I need to have missed before I get a notice of default? How many payments? Well, I guess technically one, but typically you're going to be 3 or more payments down, right? You've missed 3 or more payments. The lender will then record a notice of default against the property. Then by law, and you might want to make a little note of this, after the notice of default, there is a statutorily or legally prescribed 90-day reinstatement period. So the lender cannot just take the house immediately. They have to give you 90 days to reinstate. That, of course, means it's 90 days to try to get caught up and get current, pay whatever payments you're in arrears on, pay the late fees, pay any legal fees. You have time to reinstate the loan. If 90 days go by and you have not yet reinstated and paid everything up, the next step is something called a notice of trustees sale. So again, notice of default, 90-day reinstatement, notice of trustees sale, then the lender must wait 20 days, and then on the 21st day, the property could be sold at auction. So notice how quick this is compared to, let's say, a judicial foreclosure. Compared to a judicial foreclosure, which could take years, plus you got redemption in that deal, this could take as little as 4 months. So again, notice of default, 90-day reinstatement, notice of trustee sale, 20 days, and on the 21st day, the property could be sold at auction. That's our non-judicial foreclosure process, also called a trustee's sale. Now, again, one key note that you might want to make in your flow chart you wrote at the bottom of 242, I hope you wrote the words no redemption period. With a trustee sale, we don't have the right of redemption, meaning that after the trustee sale happens, the borrower has no time to basically buy that property back. You got reinstatement, but remember, reinstatement is prior to the sale. Redemption is the right to buy the property back even after the sale. So again, we could foreclose judicially in a deed of trust, but we would never do that. Why? It takes too darn long. That's why we got rid of mortgages to begin with. So first step, notice of default, 90 days. Notice of trustee sale, 20 days. And on the 21st day, the property is sold at auction. So again, much cheaper, much faster than a judicial foreclosure, and we don't have the right of redemption. Now, here on 243 through 245, you'll see that there's a sample deed of trust. This would accompany a promissory note, right? Remember, the promissory note is the promise to pay and evidence of the debt. The trust deed is the security instrument. It identifies collateral that would be forfeited in the event that you don't pay on 243, 244, and 245. Now, a couple of things you might want to look at on 247. We talked about this already at the top of 247. You'll see the term right of redemption in bold. Remember, with a deed of trust, there is no right of redemption following a trustee sale. The sale is 100% absolutely final at the top of 247. Now, if you don't leave, God forbid, if you lose your house in foreclosure and you don't leave at the top of 247, the lender will just evict you through an unlawful detainer process, and you'll see this term at the top of 247. Now, additionally, at the middle of 247, you'll see, of course, the term reconveyance deed at the middle of 247. You know that a reconveyance deed is the document that we use once the property has been paid off. So the trustee will give you a deed of reconveyance after you pay off the beneficiary lender. So again, 3 parties in a deed of trust: trustor, trustee, beneficiary. Who's the owner? The owner, of course, is the trustor, ends in OR. The beneficiary is the lender. The trustee is going to hold title to your property while you owe the bank money. If you don't pay the bank, the beneficiary, the bank will tell the trustee to sell the property through a trustee sale. After the trustee sale, there is no right of redemption, meaning that you have to leave right away. If you don't leave, they'll just evict you, top of 247, through an unlawful detainer. But if you pay off that promissory note, the trustee will give you the title back through something called a reconveyance deed here on page number 247. Again, following a satisfaction, middle of 247, as following a satisfaction of the debt, the trustee will issue, of course, a deed of reconveyance. So, I did this class here at our Pasadena office recently, and there was an older woman up front. She was probably in her, probably late 70s or early 80s. She goes, getting a real estate license, which I thought was great in her retirement. And she goes, my husband and I paid off our home in the 70s, and, we burned the deed. I told her, I'm sure you burned a lot more than that in the 70s. She laughed a little too long and a little too enthusiastically, which was fine. But I said, what deed did you burn? Now, do you think she burned the reconveyance deed? Well, I hope not, because if you burn the reconveyance deed, you're burning proof that you paid off the loan. Of course, if you're going to burn anything, you're going to burn the trust deed, which is the security instrument that says that the bank can take back that property in the event that they don't get paid. So, you're not going to burn the deed of reconveyance because that's proof that you paid it off, but you might burn the trust deed following a satisfaction. So these are the differences between a mortgage and a deed of trust. Remember, in a mortgage, how many parties do we have? We got 2 parties in a mortgage. In a deed of trust, we have 3 parties. In a mortgage, we foreclose judicially. In a deed of trust, we could foreclose judicially or through a trustee sale. The lender has the option of requesting either one. And remember, following a judicial foreclosure, we have a right of redemption. We don't have a right of redemption, of course, following a trustee sale here on page number 247. So if you look here on 252 and 253, real estate lenders, the primary mortgage market. Now, when the book talks about the primary mortgage market here at the top of page 252, really what we're talking about with the primary mortgage market is the initial origination of the loan. When a loan is initially originated, that, of course, is known as the primary mortgage market. In Chapter 9, we'll talk about the secondary mortgage market, which basically is the transfer of an existing loan from one person to another. So again, the transfer of a loan from, let's say, Wells Fargo to Bank of America, and then Bank of America to JP Morgan Chase, that is the secondary market. The primary mortgage market is the initial origination of the loan here on 252 and 253. Now, one thing before we talk about the different types of lenders out there, one thing I want to share with you is at the middle of 252, you'll see this gray box that says loan to value ratio and PMI. Now, think about this for a second. What do you think the hardest thing is for a lender to figure out? The most difficult thing for a lender to try to determine, of course, is the risk associated with originating that loan, right? The odds of you paying them back. The lender's trying to figure out whether or not you're going to pay them because, real estate loans, as you know, are for 15 years or 30 years. Could life change in 30 years? Yeah, life could change in less time than that. So because of the long-term repayment schedule of most real estate loans, the risk is, I don't know if you're going to pay me. But Wells Fargo's basic protection, of course, their basic protection that Wells Fargo has is the property itself. So the property itself, the collateral, is the basic protection that a lender has. Now, if you look at page 252, where it says loan to value, this level of risk could be mathematically determined by something called the loan to value ratio. So the loan to value ratio is a ratio of the loan amount to the value of a property, right? That's called the loan to value ratio. It's a ratio of the loan amount to the property's value. So think about this. Imagine you had a house that had a value of, let's say, $100,000, and you have a loan on it for $100,000. So you've borrowed the entire value of the property. Do you suppose that's a risky loan or a safe loan for a lender to make? That's a risky loan, right? Of course, because how much money have you put down in that deal? You put down nothing, right? You've borrowed the entire amount of the property. So aren't you then, because you really have no skin in the game, aren't you more likely to walk away from something that you have very little invested in? Of course, right? So lenders know that when you have high loan to values like that, where you've borrowed the entire amount of the loan, a very high loan to value, there's significant risk in that deal. And that's a very common exam question. You might want to put that on 252 somewhere. Lenders know that the higher the loan to value, the higher the risk, right? The higher the loan to value, the higher the risk. And that's a note you might want to put on page 252. Now, imagine instead of having a $100,000 property and a $100,000 loan, imagine that same $100,000 property only had like a $10,000 loan on it. Now you have $10,000 that you owe against a property that's worth $100,000. That's a low loan to value. That's only 10%. That means the borrower's got a lot of equity in the property. So again, two questions for the test, very commonly asked. Lenders know that the higher the loan to value, the higher the risk. Lenders also know that the lower the loan to value, the greater the equity position of the borrower. Again, two very common concepts. Again, lenders know the higher the loan to value, the higher the risk. The lower the loan to value, the greater the equity of the borrower. And this concept of PMI, you'll see this at the middle of 252. PMI, of course, is private mortgage insurance. PMI will exist on loans that have one loan greater than 80% of the value of a property. So let's say that you had a $100,000 property, you put 10% down, you have a 90% first trust deed. Because that loan to value is over 80%, that loan will have a monthly insurance premium called PMI, or private mortgage insurance. So again, what is private mortgage insurance? It's insurance that you pay monthly anytime you have one loan greater than 80% of the value of the property here on page 252. So again, broad review. Lenders know the higher the loan to value, the higher the risk. The lower the loan to value, the greater the equity position of the borrower, here of course on page 252. Now, leaving all that aside, there are two basic lenders, groups, that you could get a home loan from. One group are institutional lenders, here on page number 252. Institutional lenders, for right now, for the test anyway, can take one of two forms. Institutional lenders could either be commercial banks or insurance companies. And when I say insurance companies, I'm generally referring not to car insurance or to homeowners insurance companies. I'm generally referring to life insurance companies that invest money in real estate lending. Now let's start here on 253 with a couple of loan terms at the top of 253. First, of course, you'll see the term, before I forget, because I know these often come on the test too. If you look at the bottom of 252, you'll see two terms at the bottom of 252 that are important for the exam. Almost forgot. Bottom of 252, you'll see the term open-end mortgage. Now, an open-end mortgage is like a home equity line of credit. It's like a revolving loan. So you might have a bunch of equity in your house. You don't want to take a whole loan out, but you might want a line of credit in case you have an emergency of some kind. That's called an open-end loan. It's like a credit card would be an open-end type loan. A home equity line of credit is an open-end loan because you're not borrowing necessarily a fixed amount today. There's an open-end line of credit that you could draw from as you see fit. So that's, of course, known as an open-end loan. Typically, just so you're familiar with this, typically those loans are on an adjustable rate basis because the lender doesn't know when you're going to draw on that loan, and the cost of borrowing might be different at some point when you try to, draw on that line of credit. Another term you might not be so familiar with here at the bottom of 252 is, of course, known as a lock-in clause. So a lock-in clause is kind of like a prepayment penalty on steroids. You've probably heard of a prepayment penalty. That's where if you pay off the loan early, you'll pay a penalty for paying it off early. Now, a lock-in clause is much more severe than that. With a lock-in clause, if you try to pay off your loan early with a lock-in clause, the lender will just send you the money back. It prohibits an early payoff of the loan. Now, the reason that we're probably not so familiar with a lock-in clause is because this is actually prohibited on 1 to 4 unit residential property. You cannot have a lock-in clause on a residential loan. It's in fact not uncommon on commercial loans, though big commercial loans, $60, $70, $80 million on a commercial loan. A lender's going to go through a lot of hassle to fund an $80 million loan. They're not going to want you to pay that loan off in a week, right? They're going to say, hey, look, I went through all that trouble and you pay me off in a week. No. You have to carry the debt for a certain period of time. So again, a lock-in clause prohibits an early payoff of the loan, prohibited on residential 1 to 4 unit properties in California. Now, if you look at the top of 253, some common loan clauses that we should know at the top of 253. One of these we already know, a fully amortized loan. A fully amortized loan, we talked about this earlier, is principal and interest with the balance reduced to zero, right? That's a fully amortized product. If you look at the top of 253, another term that's important here is a partially amortized loan. That's where maybe you pay off some of the loan, but then not all of it is paid off at the end of the loan term. You might have like a big balloon payment. So a partially amortized loan, the loan will be paid off to a certain amount, but not fully, and then maybe you have a balloon payment at the end. There's also, of course, a non-amortized note. We talked about that earlier. That's, of course, known as a straight note. It calls for payments of interest only on the loan here on the top of 253. Then we have something that's insane, negative amortization at the top of 253. Now, if amortization is the balance being reduced, negative amortization is the opposite. The balance is actually rising over time. And this is despite the fact that you're making a monthly payment each and every month. Now, you might say to yourself, how could that possibly happen? How could you make your payment every month, and despite the fact that you're making a payment every month, your balance would still rise? Now, I'll give you an example of this. Recently here, my mother needed a new washing machine. She sent me a text message. I didn't even know she knew how to do that, but she sent me a text message saying, son, my washing machine has broken. Please buy me another one. And I said, no problem. If your mother asks you to do something, you generally have to do it, no matter what it is. So I said, well, do you have one in mind? And she sent me this ridiculous washing machine that was connected to the internet. You could check soap levels from your phone. I mean, a 70-year-old woman does not need such a device. But anyway, I relented and I went to a local appliance store and I bought the washing machine. It was like $1,500. And the salesperson was, I guess they knew that I was like, how the hell could a washing machine cost $1,500? So the salesperson said, don't worry about it. We have 90 days, same as cash. I said, well, what's that? They go, well, we'll check your credit if it's okay. We'll send your mother the washing machine. At the end of 90 days, you paid off. There's no interest. So I said, okay, $500 a month. I can deal with that. Send it to my mother. Now, I forgot to pay off the washing machine in those 90 days. So, of course, there's interest. So the loan for the washing machine was $1,500. It ended up being like $1,700 because I didn't pay off the loan. Fine. Now, what was weird was they sent me my statement. It said balance $1,700, minimum payment $10. Like, well, that's okay. Fine. Here's $10. So I sent the credit card company $10. Next month, I got my statement. Payment received $10. New balance $1,740. What the hell? I paid you last month, and the balance rose. Well, what they didn't tell me is that mathematically, the amount that I owed that month was $50, right? I owed them $50. They only asked me for $10. So the difference between the $10 that I paid and the money that I owed just got stacked onto the loan balance, which caused the balance to rise over time. Some genius figured out you could sell people houses this way, where you have a very expensive house loan, let's say, but the payment is so low, it's not even enough to cover the interest that's owed that month. So over time, as you keep making these really small payments, the balance will rise over time, negative amortization. Now, of course, this has now been outlawed in California. Arnold Schwarzenegger, on October 11th of 2009, signed legislation that banned new negative amortization loans in California. So negative amortization sounds real cool because you can have $1 million loan and only pay like $2,600 a month, but there's no such thing as a free lunch. The difference between what you pay and what you owe just gets stacked onto the loan balance. Now, a lot of banks made loans like this in 2003 and 4 and 5, like Countrywide, AmeriQuest, IndyMac, Washington Mutual, World Savings. It's like a graveyard of banks. Or all these banks made these very high-risk loans, and those banks are no longer around. But negative amortization, what is it? It's where the payment is not even enough to cover the interest that's owed, which causes the balance to rise over time. Now, we're talking about types of lenders here on 252 and 253. One type, which we already talked about, are the commercial banks at the middle of 253. Commercial banks, a couple things that you might want to write down for the exam. The first thing I would write on 253, next to commercial banks, I would write the words wide variety of loans. Commercial banks make a wide variety of loans. That means you can go to a bank and get a credit card loan and a student loan and an auto loan and a home equity loan and a construction loan and all kinds of different loans. So if the question on the exam were to say, the type of lender that makes the widest variety of loans, commercial banks. And you'll see this, by the way, at the middle of 253 in that gray box. It says banks make the greatest number of different types of loans. Another note that you might want to make on 253 is I'd write the words active in construction lending. Commercial banks are active in construction lending. So if the test were to ask you, the lender that would most likely make you a construction loan is who? Your answer, commercial banks. Now, right below commercial banks, you'll see, of course, insurance companies. Right next to insurance companies, I'd write a couple things. First, I'd write the words large loans, $3 million and up. Life insurance companies are the lender that would most likely make you big loans, like $3 million and up. So on the exam, you might see this asked backwards. The question on the test might say, the lender that is least likely to make a small loan on a condo is who? Your answer, insurance companies rather. Insurance companies aren't going to make small loans on condos. These guys are going to make large loans, $3 million and up. Another thing you might want to write next to insurance companies, I would write the words use loan correspondents. Life insurance companies use loan correspondents in order to find and help fund these loans. So life insurance companies, how do they find these large $3, $4, $10, $20 million loan opportunities? They have loan correspondents. So if the question on the exam were to say, the lender that relies on loan correspondents is who? Commercial banks or insurance companies? Your answer, insurance companies, right? Rely on loan correspondents. Now, these are, as the book says on 252, these are institutional lenders. There's another group called non-institutional lenders, and you'll see these at the middle of 255. Non-institutional lenders can take three forms for right now. They can take the form of a mortgage broker, a mortgage banker, or a private individual. So institutional lenders are like banks, JP Morgan Chase, One West, Wells Fargo. They're institutional lenders. Big life insurance companies are institutional. Non-institutional lenders are going to be mortgage companies, like on 255 and 256, like mortgage brokers and mortgage bankers. Now, if you look at the top of 256, this gray box is very interesting, right? Mortgage brokers versus mortgage bankers. Now, think about this for a second. What is a mortgage banker? And how does that differ from a bank? Well, a mortgage banker is a company or entity that you might not have ever heard of, a company like, Movement Mortgage or C&G Financial Services. These guys aren't banks. You don't wait in the line to see a teller to make a deposit. These mortgage banks basically have a line of credit. And you might want to write that down somewhere on 255 or 256 next to mortgage banks. Mortgage banks rely heavily on a line of credit. So if I'm a mortgage banker, again, I'm not a bank, I'm a company that has, let's say, a $10 million line of credit with, IndyMac or formerly IndyMac, One West Bank or Wells Fargo or Bank of America. Now, I'll use this $10 million line to fund loans. So you come to my mortgage bank and you want to borrow money to buy a house, you need $600,000, I'll fund that loan for you. But where am I funding that loan from? I'm using my line of credit that I got with some other bank. Now, eventually, over time, what's going to happen to this line of credit is that it's going to get maxed out, right? I'm going to keep funding loans. I'm doing my job. I'm selling. I'm originating loans. Eventually, my $10 million line of credit is going to get tapped out. I will need to then, with these loans, sell them in the secondary mortgage market. Once I've sold these loans on the secondary mortgage market, now I can free up my line of credit and make new loans. So a mortgage banker will rely heavily on a line of credit that they obtain from another bank, and then eventually that line of credit will get tapped out, and I'll need to sell those loans on the secondary mortgage market here on page number 256. So if the question on the exam were to say, the type of lender that relies heavily on a line of credit is who? A mortgage banker. Now, they'll need to sell those loans on the secondary mortgage market. Now, how does a mortgage banker differ from, top of 256, a mortgage broker? Well, a broker, like a real estate broker, I don't actually own any of the buildings or houses that I sell. I'm just a middleman, right? Here's a buyer, here's a seller. I'll introduce the two, collect a commission, and be done. A mortgage broker would work the exact same way. A mortgage broker doesn't actually have any money of her own or his own. They simply introduce a lender with the borrower, collect a commission, and they're done. Now, think about this. Who might go to a mortgage broker? Now, the truth is, for the most part, if you're an engineer and your spouse is a pharmacist, and you have a golden retriever and a Honda Accord and 2.4 kids, you probably don't need to go to a mortgage broker because you can just go to a bank and you'll get a better deal straight from Wells Fargo, let's say. But maybe you're self-employed. Maybe, in fact, one country last year, not this year, last year, one country brought more money into the U.S. to buy U.S. real estate than any other country. And I know a lot of people think it was China, but it was actually Canada. Last year, Canada brought in more money for the purchase of U.S. real estate than any other country. Now, 2015, of course, it's going to be China. And in the late 80s, it was Japan. And, a lot of countries like to invest, a lot of foreigners like to invest in U.S. real estate. Now, let's say you have a wealthy person from, Taiwan, or a wealthy person from Montreal, or from Spain or the UK or wherever, right? They come here to the U.S. and they want to buy U.S. real estate. Now, you take them to Wells Fargo to get a loan. They'll say, hello, what's your social security number? And they'll say, what the hell is that? They'll say, well, let me see your U.S. tax return. I don't have one. Now, they're wealthy, but they don't meet traditional underwriting criteria. Maybe a mortgage broker knows of a lender that's willing to make that loan on non-traditional terms. Maybe you're self-employed and you don't have a tax return that makes it's legal, but it doesn't put you in the best light. A mortgage broker might know someone who's willing to make you a loan on non-traditional terms. So we got a few different lenders, right? Commercial banks, institutional. They make the wide variety of loans. They're active in construction lending. We got insurance companies. Insurance companies make large loans, $3 million and up, and they rely on loan correspondents in order to find and fund their loans. Mortgage brokers, they're not going to actually lend their own money. They're just going to introduce a lender with a borrower and collect a commission for doing so. We got a mortgage banker that'll have a line of credit. They'll fund the loan from the line of credit and then sell those loans in the secondary mortgage market. Now, the last non-institutional lender we should know is here on page 256, and it's private individuals. Private individuals are the largest source of junior loans in California. And you might want to write that down on 256. Next to private individuals, these are the largest source of junior loans in California. Now, what's a junior loan? A junior loan is like a second or a third. Any loan that's not a first is a junior loan. Let me tell you how this happened over time. What happened was, you want to buy my house, it's worth $300,000. You're good for $280,000. Now, you asked me to sell it to you for $280,000. I say, no, it's $300,000, take it or leave it. And you're like, well, all I got is $280,000. You have $250,000 from a bank, you got $30,000 of your own money, you're short $20,000. I, as the seller, could carry back a junior loan and help you complete the purchase. Now, the benefit for me is that I get to sell my house. That's what I want to do anyway. Another benefit is that on that money I'm lending you, that $20,000 I'm carrying, I might charge you 6.5% or 7% or 7.5% on that, which is more than I'll get at the bank if I left that money at the bank. So I'll get a higher return. I'm still secured by the property, and it allows me to sell my home. So many private citizens did this over the years that today private individuals are the largest source of junior mortgage loans in California, here on page number 256. So those are our lenders, right? Private individuals, mortgage brokers, mortgage bankers, insurance companies, and commercial banks. So let's look here at page 259. If you look at 259 through 264, you'll see a lender purchaser disclosure statement. This is a form under the California Bureau of Real Estate. There aren't any form questions on the exam any longer, but I'll let you look at that on your own. One thing I do want to share with you are two laws here on 266. One is called RESPA, and one is called TILA. RESPA is the Real Estate Settlement Procedures Act. Another is called TILA, or the Truth in Lending Act. Now, there are this rule just went into effect August 1st of 2015, so it's a new way of doing business in our real estate world. There's a disclosure form that has kind of been integrated, right? RESPA and TILA, it's actually called TRID, T-R-I-D, or the TILA RESPA integrated disclosure. So some aspects of both of these laws have kind of been combined into one disclosure called TRID, again, or the TILA RESPA integrated disclosure. But I want to share with you a few things that are inside of TILA and a couple things that are inside of RESPA. Now, again, a lot of the aspects of these laws have been integrated into TRID, or the TILA RESPA integrated disclosure. And you'll see, let's start here, of course, on 266 and 267. Now, on 267, one thing that I look at the top of 267 in bold, you'll see the term loan estimate, or LE. So this used to be called the good faith estimate under RESPA. Now it's simply called the loan estimate here at the top of 267. Now, this loan estimate, and you'll see this in figure 8.9 if you look at 268. Notice what this loan estimate is attempting to show. If you look at 268, it's attempting to show the loan terms, the loan amount, the interest rate, the monthly principal and interest payment here on page number 268. If you look at 269, it's going to show a lot of the closing cost details on 269. What's the cost of that loan? What's the loan gonna cost you here on page number 269? Now, this used to be, if you're kind of an old school real estate person or you've been studying real estate for a long time, in another capacity, you know that this was just the good faith estimate. The good faith estimate would just be an estimate of the closing costs associated with the loan. Now, this new loan estimate doesn't just have the closing cost in there. It's got an estimate of your interest rate on page 268. It's got an estimate of the monthly payment. So it's a more comprehensive disclosure under TRID, or the TILA-RESPA Integrated Disclosure Rule. Another thing I'd look at here at the bottom of page 267, you'll see the term closing disclosure at the bottom of 267. The closing disclosure really replaced something called a HUD-1, and the book says this on 267. The HUD-1 was the final form that you were to get when a real estate transaction closed. This is no longer called the HUD-1. This is called a closing disclosure here on page number 267. And by the way, you'll see this at the middle of 267, this term new 3-day waiting period. If the creditor, that's the lender, provides a corrected disclosure, it may also be required to provide the consumer with an additional 3 business day waiting period before the deal closes. So if the lender is making changes to the closing disclosure, this might create an additional 3-day waiting period where the borrower's got time to look at the new disclosure, cool off, wait 3 days, and then make a decision as to whether or not they want to move forward based on the changes in the disclosure requirements. So again, the good faith estimate, as it was called before, is now called a loan estimate here at the top of 267. The HUD has been now termed the closing disclosure, and it may require an additional 3-day wait if there are some material changes in the closing disclosure on 267. Now, one thing I also want to share with you here on page number 272 at the top, where it says impound accounts. Now, right next to impound account, I would write the word reserve. The term impound is another term for saying reserve. Now, think about this for a second. Property taxes, for example, are considered delinquent in December and in April. So a lot of people in December have a very tough time in December because your property taxes are due, and we got Christmas and Hanukkah and Kwanzaa, or whatever you celebrate. You know, December is often an expensive month for a lot of people. What sucks about that is that you also have a pretty gnarly property tax payment that's due in December. Then, of course, we have the other half of taxes that are considered delinquent in April, which we have income tax time and all this sort of thing. So that's also a source of stress for a lot of property owners. You could, with your lender at the top of 272, set up something called an impound account. Now, an impound account is also called a reserve account on 272. It's a reserve account that's set up by your lender mainly to pay 2 things. Those 2 things are property taxes and hazard insurance. So instead of making these property tax payments in, let's say, December and in April when they're considered late, you could pay a little extra to your lender, and your lender will stack this money aside for you in something called an impound account. Then, as these payments come due, your lender will fire off these property tax payments for you as they come due. So an impound account is also called a reserve account, and it's set up to pay property taxes and hazard insurance. Now, a lot of financial planners will say, hey, don't get an impound account. You're paying extra every month and your lender's, stacking it for you, but you could take that money and invest it somewhere else and come back in December and April and pay. But most of society, as you know, is, at least I'm definitely not that organized, frankly. So for a lot of people, the impound account is useful because they don't have to budget as hard. They pay one payment every month. It's property taxes, it's insurance, it's principal, it's interest, and it's all in one account. But if the question on the exam were to say, the term impounds expresses a meaning most closely related to what? Your answer, to the term reserves, right? Impound and reserves basically mean the same thing. And what is it used to pay? It's used to pay property taxes and hazard insurance. Now, another thing that's worth looking at here is on page number 273, and it's other loan considerations here at the middle of 273. Now, there's two ways to take over my loan. One way is a loan assumption. Another is you could buy my house subject to the existing loan. So here on page 273, in a loan assumption, you buy my house and you take over my payments and also the liability for making those payments. So you buy my home, I give you a deed, and you assume my loan, let's say. Now you just start taking over my payments for me. Now, here in 2016, you're probably not so familiar with a loan assumption for a couple of reasons. First, do you think your lender is going to be okay with me buying your home and me simply taking over your payments? Probably not, right? The lender doesn't know me. They don't know if I'm rich or poor. They haven't checked my credit or my income. They know nothing about me. So if a lender finds out that I bought your house and the loan is still on there, the lender might call the loan due. That's called an alienation clause, which we'll look at here in a moment. But if I was able to assume your loan, I would then take over primary liability on that loan. That's a loan assumption. I could also do something called a subject to deal at the middle of page 273. This is where you deed me your house and you retain liability on the loan. Now you might say to yourself, why the hell would anybody do that? Why would you sell me your home? I own it, but you still on paper are liable for paying. Well, it's not common, but maybe I'm going to then turn around and sell that property to someone else. Now, in order to do that deal, I might say, look, I'm going to buy your house, but I'm going to flip it to someone else. I might need to buy it subject to, where you retain liability on the loan, but I assure you that I'll sell it to someone else within, a week or whatever it is. Very risky for you. But if the question is on the exam, the type of deal where one person buys another property, but the seller retains liability on the loan, is that assumption or subject to? Subject to. You as the seller retain liability on the loan. Again, not common, but that's called subject to. If I assume your loan, I am now the first one responsible for paying under that promissory note. So another thing I'd look at here on 273 and 274 are two last loan clauses, acceleration and alienation. So we'll start with acceleration here at the bottom of 273 and the top of 274. An acceleration clause is a clause in a loan where a lender could basically call your loan due if you freak them out. So if you upset your lender, they might be able to call the loan due even before this 30-year period is up. Now, how could you freak your lender out? There's a list at the top of 274. You might miss a bunch of payments. You might not pay your property taxes. You might commit waste or start using the property illegally. Any of these things could freak a lender out to the point where they call the loan due. This is called an acceleration clause. So again, very commonly asked on the test, the type of clause in a loan where a lender calls the loan due to some material breach, that's of course acceleration. Don't confuse acceleration though with something called alienation here at the middle or the top half of 274. An alienation clause is also called a due on sale clause. So an alienation clause is due on sale. Again, if I buy your home and I just take over your payments, generally the lender is not going to be okay with that. This is going to freak them out to the point where they call the loan due because you sold the property and left the loan on there. That's called an acceleration clause. Now, or that's called an alienation clause rather. So again, an alienation clause is a clause in a loan where the lender calls the loan due because the property was sold, but the loan stayed on there. The lender's not going to be happy about that. They don't know who you sold it to. This will trigger an alienation. Again, acceleration and alienation, they're very similar because in both instances, the lender will call the loan due. The difference is, why are they calling it due? If they're calling it due because you sold the property, that's alienation. If they call it for any other reason, that's called acceleration here at the bottom of 273 and the top of 274. Now, a couple of last things here. I know this is a long chapter. This is the longest one in the book. We're almost there. So middle of 274, construction lending. So you already know construction loans are generally obtained from who? Your answer, from a commercial bank, right? A commercial bank is generally going to be the construction lender. Now, do you think a construction loan is a risky loan or a safe loan for a lender to make? Very risky, right? Because the collateral doesn't exist yet. I mean, how many times do you think a developer has started to build, let's say, a building or a shopping center or something like this, and he or she gets halfway through the project and says, oh my God, I'm so over budget. I can finish this project and lose $5 million, or I can just cut my losses now, walk away and lose $1 million. 9 times out of 10, they're just going to probably walk. So a construction loan is a risky loan, mainly because the collateral doesn't exist yet. So a construction loan is going to have a higher interest rate than a long-term loan because it's riskier. As a developer, I don't want my construction loan for a long time because, of course, the interest rate's going to be higher. So a construction loan is basically a short-term loan made specifically for the period of construction. The test may call this an interim loan here on page number 274. A construction loan is also known as an interim loan. It's a short-term loan made specifically for the period of construction. Once the construction's finished, we're then going to refinance this interim loan into a long-term loan called a takeout loan here on page number 274. So again, an interim loan is a short-term loan made specifically for the period of construction. Once the construction's finished, we want to get out of that interim loan because the rates are higher into a long-term loan called a takeout loan. So again, true or false? An interim loan and a takeout loan are the same. No, an interim loan and a construction loan are the same. It's a short-term loan made specifically for the period of construction. Once the construction's finished, we then refinance this into a long-term loan called a takeout loan here on page number 274. So, oh, by the way, one quick thing here. Think about this. When do you think it would be wise to get a takeout commitment? When would it be wise to make sure you have your takeout loan set up? Now, you definitely don't want to wait till the construction's finished to try to go get a takeout loan, because what happens if the construction's finished and then you can't qualify for a takeout loan, or the lending environment is very tight and you can't get a takeout loan? So you're going to want a takeout commitment at the same time you get your interim loan. Now, you might have to pay something called a standby fee, and you'll see the term standby fee at the bottom of page 274 where it says standby commitment and standby fee. You might have to pay a standby fee for the privilege of having that takeout loan money parked for you, but that's a heck of a lot safer than waiting till the construction's finished and then trying to scramble to get a takeout loan. Now, the last thing from this chapter is here at the bottom of page 274 and the top of 275, the loan application. Let me ask you this. Do you think that the loan application that your bank will use will ask you for your race? Now, of course, you're probably saying, of course not. Why would they ask you for your race? They should not ask you for your race. It should be based on your credit. But in fact, the Uniform Residential Loan Application, also called a 1003 form, it's the same home loan application we use in Beverly Hills and in Des Moines, Iowa, and Miami, Florida. Every residential lender pretty much uses the same loan application. It's called a 1003. And in fact, that loan application will ask you for your race. And in fact, it goes so far as to say, okay, it's not required. You don't have to tell me your ethnicity on the app. But if I'm a lender and I'm taking the application face-to-face and you decline to tell me your ethnicity, the loan application says, and you can just do a Google search for 1003.pdf and look at this for yourself, it says if the loan officer is taking an application face-to-face and the applicant doesn't want to provide their ethnicity, the loan officer has to make a reasonable determination, basically a guess, as to what your ethnicity is based on how you look and what your last name is. Now you might say, why the hell would this be such a sticking point that the government, or the loan application rather, is going to require that somebody check that box on a face-to-face application? It's actually to prevent discrimination. If a bank got audited or a lender got audited and there was a pattern of, let's say, red people or blue people with great credit paying higher interest rate and higher fees than, let's say, purple people with the same credit, this might be evidence of discrimination. So the loan application will ask you for your race, but it's actually to prevent discrimination on an audit, to make sure that people are not having loan terms offered to them on different rates and terms based on their ethnicity. So again, a lot of stuff here in this chapter. We talked about promissory notes and trust deeds and negotiable instruments and mortgages and loan clauses and types of lenders. I'd encourage you, do the quiz for this chapter. A lot of stuff in this chapter. Do the quizzes at the end of the chapter and the ones online. And if you have any questions, let us know.